All right, welcome to The Explainer. Today, we're jumping into something that, let's be honest, impacts pretty much all of us, the real estate market. I mean, whether you're trying to buy a house, just paying rents, or even just glancing at the news, it can feel like a complete roller coaster.
You know the feeling, right? One minute, prices are skyrocketing and it feels like you'll never be able to afford a place. The next, you hear they're dropping. It seems totally random. But what if it's not? Turns out the housing market is a lot like the ocean tide. It has its own rhythm, its own ebbs and flows. And today we're going to pull back the curtain and look at the powerful and often invisible forces that are really in control. So first things first, let's talk about the ride itself, the real estate roller coaster. So this whole idea of a real estate cycle, what is it really? Well, at its heart, it's actually a pretty predictable pattern. The market expands, it hits a peak, then it contracts or shrinks back, hits a bottom, and then, well, the whole thing starts all over again. It's really just a big dance between two fundamental ideas, supply and demand. And that dance creates two basic situations. When you've got way more people who want to buy houses than there are houses available, that's a seller's market. Prices go up and builders can't build new homes fast enough. But when the opposite happens and there are too many houses on the market and not enough buyers, it flips. Suddenly, it's a buyer's market. Prices start to fall and construction pretty much grinds to a halt. The whole cycle is just the market swinging between these two extremes.
So that brings up the million-dollar question, right? What is actually pushing the market from one side to the other? Let's take a look at the forces working behind the scenes.
You know, there's a whole bunch of things at play here. You've got demographics, like who is actually at the age to be buying a home. Even things like social attitudes play a role. But the big one, the one factor that is more and more becoming the main driver, is the availability of mortgage funds. Or to put it simply, how easy is it for you to get money to buy a house? And this is where it really hits home, because how easy it is to get money is directly tied to prices and interest rates. And even the tiniest little changes can have a massive, massive impact on what you end up paying every month. Let me show you what I mean with a real-world example. Okay, so let's imagine there's a house and you need a loan for $160,000 to buy it. At a 5% interest rate, your monthly payment is going to be around $859. Manageable, right? Okay, but hold on. The market gets hot, it's a seller's market, and the price of that exact same house shoots up. Now you need a $240,000 loan. The interest rate is still the same, 5%, but just look at that payment. It's jumped by over $400 a month. That is a huge difference. And we're not done yet. Let's say interest rates just tick up by one single percentage point, from 5% to 6%. Your payment jumps again by another $150. So all in all, these small changes have added nearly $600 to the monthly cost for the exact same house. That right there is the incredible power of these forces at work. This brings up a really interesting question, though. I mean, think about it. If your local bank is handing out hundreds of these massive loans, where are they getting all that cash? They don't just have billions of dollars sitting in a vault somewhere, right? Well, the answer to that question takes us deep inside the engine room of the entire U.S. housing market. It's a system called the secondary mortgage market, and its whole purpose, its main job, is to provide liquidity, which is really just a fancy word for cash, to the lenders that we all deal with, our local banks and credit unions. So here's how it works, and it's actually pretty straightforward. First, you go to your bank, that's what we call the primary market, and you get your mortgage. Then your bank turns right around and sells your mortgage to one of the huge players in the secondary market. This instantly gives your bank a fresh pile of cash, which they can then turn around and use to give a mortgage to the next person waiting in line. It's a pretty clever system for keeping the money flowing. So who are these giants buying up all the mortgages in the country? Well, let's meet the market makers.
You're looking at the three main agencies that basically run this whole show. And I bet you've heard their names before: Fannie Mae, Ginnie Mae, and Freddie Mac. Now, Ginnie Mae is actually owned by the government, but Fannie and Freddie are technically private companies, although there's a huge asterisk next to that word, private.
And that asterisk comes from some pretty recent history. You see, back in the financial crisis of 2008, the government had to step in and basically take control of both Fannie Mae and Freddie Mac to stop the entire market from collapsing. It was a massive, massive move. And believe it or not, to this day, they are still under government control. That's just how crucial they are to the whole economy. Okay, so why does any of this matter? I mean, who cares about this alphabet soup of giant, complicated agencies? Well, you should, because what they do affects you directly.
You see, it all boils down to this. The real power of the secondary market isn't just the money, it's the rules. It's the standards that they set for everybody else in the game.
And this right here is the most important thing to understand, because your local bank wants to be able to sell your loan to Fannie Mae or Freddie Mac. They force you to play by Fannie and Freddie's rules. Their guidelines for things like your credit score, your income, your debt-to-income ratio, those become the rules for your loan application. In a very real way, these giant agencies are the gatekeepers to you owning a home.
Which leaves us with one last and pretty big question. We've built this entire system to provide the cash that fuels the American dream of homeownership. It's a system designed for stability, but it's a system so huge and so important that its own gatekeepers became too big to fail. It's an incredibly powerful engine for sure, but it might also be a fragile one. And understanding that tension is the real key to understanding how the housing market truly works.